Welcome back, everybody, to the show, Be the Trader. Today, I have a very special guest, someone that, if you don't know him yet, you need to make sure you follow him on Twitter. His name's Krishna. He's from 7 Points Capital, the head trainer there in Florida. So, Krishna, welcome to the show, man.
Thank you so much, Alex. Pleasure to be here. I'm excited.
Hey, I'm excited to get you here. I love all of you guys. I don't know if anyone follows me on Twitter. I talk about y'all all the time. Y'all sharing y'all's recap videos. I love those. They're gold, and it amazes me how you guys should be way bigger on social media. And I'm like, people are missing out. They need to go look at your guys' videos because they're awesome. So I appreciate y'all doing that.
Thank you, Alex. Yeah.
Absolutely. So let's get this thing started. If you can kind of give us an idea, what started your trading journey? Because I'm sure people are curious on what got you in trading.
Yeah. So it started way before 7 Points as well. I've been with 7 Points since 2014. It's been almost 6 years. But my trading journey started even before that. My first interaction with the markets was back in 2002. So I was in the 6th grade, and I happened to have an accident, and I broke my left arm, and it was completely shattered and dislocated and broken the bones into like, I don't know, 600-700 pieces. And so it took about 3 months. I was bedridden completely for 3 months, and I was only 12 back then. So the idea was you can't really step out. You got to stay home. So the only thing I look forward to was during my dad's lunchtime, he would call me, he'd give me a call, and he'd say, can you give me quick quotes on all the stocks that I have in the long-term portfolio? So he had about like 10 or 12 symbols back then. But the only way I could get quotes was looking at the tape at the bottom of the CNBC screen. So what I had to do was wait for all the stocks from A to Z. And so I'd write it down on a piece of paper. So obviously, a couple of days later, I'd be like, hold on, I know he's going to call me at 12. So I'm going to start taking down quotes from 11:45. And then second week, I just start taking down quotes at 10 a.m., 11 a.m., and 12. And I'd be like, Dad, had you called me at 10, we could have sold it earlier. And he'd be like, all right, next time you see that, you can directly call the broker, because that's how it used to work. You gotta call the broker and place the trade. And the first time I call him to place a trade, he's like, did you call here by accident? I'm like, no, I'm trying to place a trade on behalf of Mr. Joshi. He's like, but who are you? Are you even allowed to? Because he could tell he's like a young kid on the phone on the other end, and he just hung up on me. So I'm like, no, Dad, he's not respecting me. You got to call him and tell that my kid's gonna call. Better take his orders. So that's how I got introduced to the market back in 2002. 2006 was when I first time walked on to a trading floor. I went to the broker dealer with whom I had the account, and he was the one who's really helpful. He guided me through what's a bid, what's an ask, and that's how it really started the journey for being like a short-term intraday trader, because you could get like a huge leverage for intraday basis. If you put up a small amount of capital, you could get insane amount of leverage on that capital. So 2006 is when I really started short-term day trading, and that throughout my undergrad I was actively trading. I dove into different types of strategies like short-term buying breakouts, and then pair tradings. And fast forward that, I was like, back in 2012, I was thinking, if Indian markets are getting this exciting, imagine what a US market would be. So that's when I decided to get my master's in financial engineering. I went to NYU for 2 years, and straight out of NYU, I joined 7 Points. And I've been with them since.
Nice. Oh my gosh. So this whole time I was thinking that, and maybe you correct me if I'm wrong, you were trading the India markets, not the US markets at first, and then you came over here?
So 2006 was when I actually started actively trading. So 2006 to 2012 was Indian markets. In 2012, I was working with a professor at NYU who was ex-Salomon Brothers on the fixed income side. So he was like a trader for Salomon Brothers. He was one of those professors who weren't propagating like efficient market hypothesis and buy and hold. So I was very comfortable working with him. And while doing that, I transitioned a lot of strategies from the Indian markets to make it more generic in its form, which can be applied to. Then we started trading E-mini S&Ps. Then we started looking at gold, crude oil futures. So more like a generic strategy, but transitioned all of that from the Indian markets. So when I joined in 2014, I had some sort of layup as to what I wanted to do and what I've done in the past, and how I can apply that to the US markets.
Absolutely. So I'm curious though, just real quick, when you were saying we were on the floor in the India markets, what was that like over there, being
Oh,
on the
it's
floor?
crazy. It is chaos because it's
Yeah.
like three guys with one screen. Because even one screen was like, whoa, he's got a computer screen, and then he's got like two phones on both the sides. So his phones would be over here. And the moment they would ring, he would just go on his phones and he would be taking orders, executing orders. And anyone on the floor who wanted to trade had to put the orders through him. So you would have to tap on his shoulder. So he knew that, okay, the guy on my right shoulder is Krishna, the guy on my left shoulder is the other guy. So he knew which account to quickly press and put the orders into. So it is absolute chaos. There would be 20, 25 people, and there's so many different experiences, different kinds of traders, different time frames, all sorts of crazy things happening on that floor. Like very tiny floor, but it would cramp up like 25, 30 people easily, and it would just be a lot of noise, a lot of orders back and forth, phones ringing all the time, and yeah, just crazy
That's
times though.
that
Thinking
that
about it now.
is so crazy because now it's so different and it's just so cool to hear that. I'm curious, is there anything you picked up from being on the floor that kind of helped you being now digital? And there may not be, but I'm just curious on that experience itself because it was so different back then. Was there anything
Right.
you were able to take away?
Yeah, I mean, quite a few things. I always used to think that speed was absolutely an essence, right? So, especially if you were buying breakouts in the Indian markets, so you weren't the only one. There were 25 people who would be buying breakouts along with you. So, one was speed. You had to be absolutely quick. So, that's something that I can put into action even today. The other thing was all these people, most of these guys were profitable, and everyone had a unique style of trading. So the first thing that I figured out being on that floor was I'll have to be my own unique identity. I'll have to be a unique trader. You don't really have to copy someone, but at the same time, while I was getting started, I'd pick up a thing or two from this trader. I'd pick up something else that someone else was good at. So I always knew that there were 1,000 different ways you could make money. If you could pick up a thing or two from everyone else, like someone focused a lot on volume, someone specialized only in pair trading. So if stock A went up, he'd be like, stock B has to go up. I'm just going to load up on stock B, something like that. So at the end of like at the end of 2006, when I'd spent like 3 months day in day out on the floor, there are quite a few things that I could take away from that. And at the end of 3 months, I could say that I had some sort of strategy in mind, that I knew that this is what I have to look at. These are all the different criterias and filters that go into my trading along with that.
Would you say you were profitable at that time or consistent in some way? Or were you consistent then and then you went to, graduated from NYU and then joined 7 Points as a consistent trader? Or can you give us an idea of that?
Yeah, of course. So 2006 and 7, I was at best break even. I think 2008 was my first year undergrad. The courses were, we had to take lectures, but I was able to also trade during the day. So that is when I was doing much better in terms of performance, in terms of getting consistent. But the one thing that I kept doing was I kept trying different strategies. 2008 was also when I started, I dug deep into futures and options as well. So that's when I really started getting on the derivative side as well, instead of solely being on the equity side. And 2008 was a huge crash as well. So you couldn't really, you came in, and in the Indian market, you cannot short stocks overnight. So you can only short stocks throughout the day, which also obviously had to be borrowed. So if you wanted to short sell a stock, you can only short, you have to cover by the end of the day. So to have overnight short position the only way to do that was to have puts and to have experience with options. So 2008 was sort of unique in that way for me, because that was the first year when I really started looking at options pretty actively, because you couldn't be going long overnight. So you'd at best be flat, or you'd go on with having some sort of puts overnight.
Okay, and so let's fast forward a little bit. Whenever you started 7 points, right?
Right.
So when you started with 7 points, I'm curious on some of because the first thing that comes to mind is, and tell me if I'm right or wrong. Are you in an office with a couple of more, maybe 2 to 6 more traders or something like that?
No, no, no. Back in 2014 at 7 points, we had this huge floor. We had about 20 traders on that floor. My cats would be like, you walk in the office, my cats would be right in front of you. There would be Mike Mangieri on one end, who's also one of the managing partners, and Gary Roth, who's also one of the founders of the firm, who unfortunately passed away a few years back. But he used to be on the other side of the office, and so there used to be three main guys, and in between the three of them throughout the floor, there would be 15 to 17 other traders, and who would mainly specifically trade anything from like short-term arbitrage, market making, scalping kind of strategies.
So
It
what
was
about
much
now,
different then.
though? What about now currently? Because you're in
So
Florida.
yeah, even now, I think in Florida, as the office is fairly new, it's only 2 years new. So we have four of us. I trade with Stan. I manage the Fort Lauderdale desk with him. But we have two traders, Peter and Najib, who have made amazing amount of progress over the last few months. Who also had the best months in March. Last month was the best month for everyone personally, for us
Yep.
at the Florida office, and also 7 points as a firm. So it's four of us in the Fort Lauderdale office. One of them is about to take the exam for the Series 57, but unfortunately, due to the virus, he'll have to reschedule that for like a week or two from now, whenever things open up. But we are trying to hire and sort of replicate the New York style, because that was something where the atmosphere is really lively. You'd have CNBC on one of the TVs, you'd have something else going on some of the other TVs, like someone's listening to music in the background. And everyone has a different unique personality. Everyone has different risk limits, different styles of trading. And that's what brings together the entire floor.
So I asked that question because I was curious on, you have different people there, right? Different
Yeah.
opinions, different trading styles. And how do you feel like that can sometimes mess with your trading, with your own trading? Like with all of those, like here's opinion here, here's an opinion here
Right.
on this ticker, and this guy's trading it this way, this guy's trading it this way, and you
Right.
trade this way. Like, how do you keep yourself from, I mean, how do you deal with that? Is it good for you? Do you see it as a benefit sometimes and a weakness? Can you explain
Right.
that?
I think it's definitely a strength to be surrounded with people who trade the similar strategy with you, because again, these are guys who've been trading since 2011, 2012, so super experienced guys. So the day when I walk into the office, my goal was imagining the 2006, the trading floor in India, where every trader is unique. I've got to learn, I got to pick up skills from each one of them, because they are here because they're successful and because they are good at what they do. And on top of it, every morning, my cats would do like a morning briefing. We would go over like what the global macro looks like, what are the morning gappers, gapping up, gapping down, any significant news that might impact, if there are going to be Fed minutes, if there is going to be like, we didn't have the presidential tweets back then, but any sort of like macro news that might impact the market on the day, we would be ready for that. So I always felt that it was always beneficial to have some sort of like advice, some sort of like a meeting going on in the morning, where everyone knows what you're looking at, while at the same time everyone has his own unique plan. So it wasn't like you're forming a plan in the group. It's more like you're discussing, touching every aspect of trading, all the news, all the gappers. But when it comes to when 9:30 market goes ding ding ding, you're still doing what you're good at. So it's not like you are going to trade just like the guy next to you trades. It's going to be more like you stick to your strategy, you stick to your risk parameters and your watch list, while keeping in mind that, okay, maybe this is the outlook for spies on the day. We might have a bounce, we might actually sell off, we are hitting into resistance, or like a nice support area, something like that. So it would be like a big overview or a conversation about covering every aspect of trading, and you'd pick up tiny bits and pieces of that which you think will supplement your trading plan for the day.
Yeah, I mean that makes sense, and I like that you said that because at first I thought I think it just depends on how you look at it, and how you're looking at it really shows in how you attack, that situation, and how
Right.
how you go into the office saying, "Let me get all of these ideas, let me learn." It's like you're growing that much faster.
Yeah.
But then also, I think since it seems like, and you correct me if I'm wrong, because I watched your videos too on YouTube. It seems like you trade everything, right? You pretty much trade everything as long as there's
Absolutely.
momentum. Okay, so
Yeah.
have you seen a difference? And this is just, I'm curious.
Yeah.
You have these morning meetings to discuss the overall market, to discuss
Hmm.
what you think may or may not happen, what may be making a market move. Does
Right.
that have any effect on small caps? Do you think small caps, penny stocks, those kind of stocks, or
So
are
to
they
be
kind of in
honest,
a real world of their own?
to be honest, I only started trading low floats um, early 2019. So I would say it's only been about 15 months that I've been actively trading the low floats or small caps, so to say. Up until 2018, absolutely not. Like 2014 through 2018, I never even touched low floats. 2019 onwards is when I probably trade, like January 2019, maybe one low float name a day, maybe the biggest gapper on the day. Again, like for me to be consistently profitable and to look at multiple names on the day, it definitely took about 3 to 4 months for me to be consistently profitable and worth my time, so that I can say, all right, only if I've got 6 level 2s on all my monitors, now I will dedicate 2 level 2s towards low floats or small caps, only because I think I have some sort of an edge. Up until then, I was either not touching them completely, or just reviewing what Stan might be trading, or someone else might be trading, or just formulating a plan instead of just jumping in with both feet. It just I made sure that I wasn't really going in uh, just all in into these low floats or small caps, just knowing how uncertain they are. So going back to 2014, our focus mainly was on the global macro outlook, how that might impact momentum stocks like Ford, GE, GM, and that would be momentum for us because, to be honest, there would be days when I only traded Zynga or AMD, and those stocks back in 2014 were $2 and $2.50 or $3, right? So I'm only used to and comfortable trading like small names. You'd be making a market on them on both sides. You'd be doing that day in, day out, like 9:30 to 4. You're glued to the seat. Probably never even got up from the seat all day. There would be days and weeks like that where you're just focused on high liquid, small priced, like names like Siri, AMD, Zynga, and there were days when I absolutely only traded those names. So
So
it
so
was a lot of a transition, though.
now I appreciate you saying what the background on what your experience is, because I still would like to know your opinion on, if knowing that you've been trading small caps too for not too long, but a year and a half or so.
Right.
Have you noticed how the global market affects that, or does not? In your own opinion, do you feel like it does, or?
I think on any given day, it has absolutely no impact on it. Again, this is my personal view.
Right.
I could be absolutely wrong about that. But on a day-to-day basis, I think it has no impact on it. Uh, the thesis or the catalyst behind why every stock is moving is what drives the name. So yesterday was YGYI trying to
Yep.
come up with a hand sanitizer of their own. So that stock in itself has nothing to do with is SPYs going to gap up or gap down. That's my personal view. And again, but if SPYs are dropping from 3,300 to like 3,000 over like 2 days or like overnight, that's when everything is getting hit. Everything is getting hammered in the market. And there are some
Mm.
of the names which just no bid, absolutely. No one wants to know what the bottom is in these names. So a lot of names that I used to just watch for, if they gap up, I'll probably look at shorting them. And some of those names which are trading in the 60, 70, 80 cent range, they all bottomed out at 25 cents in the middle of March. When everything bottomed out, there were like 5 names that bottomed out at 25 cents. I don't know what the significance was, why 25 cents specifically, but that was the amount of selling that was going on. It was just like panic selling, um, because these companies have no revenue. These companies need more cash. So again, why if spies are getting hit 5-7% or limit down, no one wants a piece of any of those small cap names. So I think on extreme days, they get clobbered absolutely. But on any given day, for example, like gapping up tomorrow, they'd again gap up the same day. They'll gap up the same way as they usually do, depending on how strong the catalyst is.
How do you, and since we're on the topic of global markets and affecting
Yeah.
the trade, individual trades, I'm curious on, bigger caps that, the bigger names. If you're ever trading those and the market, obviously they're affected by the market in some way, but
Right.
there's also those times where, there's those times where like the market's gapping down
Right.
but this one stock is gapping up.
Hmm.
Like, what's your approach? Is your approach more, okay, this is different, that's a good thing, or is the approach more like it's a good thing, but I need to be cautious because the market's gapped down? Like, what's your
Right.
approach with that?
So again, depends on the catalyst. Partly why, because there were two such scenarios that happened recently. One was, so what we're talking about is like having a negative correlation with the market for some reason. So
Hmm.
there were two sectors that were sort of outperforming that way. One was obviously the coronavirus names. So the likes of APT and AHPI, and then we had iBio, VXRT, all of those, the list just kept going on, right? Like 15, 20 names at the end of the month. So those were all of them which had a negative correlation with spies, because markets would go down and these guys would just go up because the coronavirus numbers or the number of patients were going up globally. So that was one aspect of it. And the other one was when people actually started hoarding all the stuff like food and toilet papers and paper towel rolls and stuff like that. There were stocks like Kroger, there was Walmart, Target. There were a couple of days in the week that they would outperform, and they would actually finish at the highs of the day, whereas the spies would finish at the bottom of the day. So you would get killed if you just stepped in front of Kroger gapping up 6%, saying market's down 3%. Why is KR gapping up? I'm just going to short it. That absolutely didn't happen. So again, catalyst is key. If it's like a banking name, so my outlook on such a day would be if you have like a banking name, Bank of America is gapping down 5%, whereas JP Morgan is only gapping down 1%. That's when I'll probably look at saying that, okay, there's a stock which has room to go down. But again, I'm looking at in the direction of the market that spies might be going down 3, 4, 5%. I think this might actually eventually pick up pace and go down much more further.
That makes sense. And are you more so, keeping that same example you just gave, right? Are you more so thinking that only, or are you also watching to make sure price action, right? Or some kind of technicals before you
Yeah,
just
yeah,
blindly short, right?
right. No, absolutely. Like even if you looked at like let's say you see a topping out pattern, you're like, all right, I'm short close to the high of the day. My stop is above high of the day. You are more likely to get stopped out and then get stopped out and get stopped out again because you're just trying to show the front side, trying to pick tops in it. So something like Kroger, which is going to finish at the highs of the day, you just end up getting stopped out on that. Um, yeah, you would, even though let's say you're looking at a level, you're looking at a big offer that you're leaning against. You're saying, oh, 30 is a massive, significant level on the daily chart. I'm going to short 29.95 with a stop above 30. I'm going to lean on the offer. It's more likely that the offer gets taken out, and then you'd be like, all right, I'll give it another chance at 30.50. You're again more likely to get stopped out because the catalyst on the stock is saying that now everyone is buying their normal groceries at Kroger. Now you've got a week where everyone is just going in. There's just long queues outside Kroger that goes all the way to the main road. You just know that these are going to be stocks which will just finish at the highs of the day. But again, even though it's a one-off event, on that specific day, I think the chances of that stock finishing up are significantly higher. So even though you'd be looking at level two tape for confirmation, which we often do because coming from the background that we come in, or where I come from, 2014 I started off just absolutely market making. You're just looking at three level twos all day, you know who the buyer is, you know who the seller is, you know how aggressive the buyer and seller is. So you're so used to watching the level two and the in-depth, like the full quote book in such a way that you know how much further room does this stock have, when is it actually going to flip up. So in such a way that you are actually able to even time the flip up or flip down in any given stock. So you're watching it so closely. Tape reliance was heavy for what we do, but again, if you're going to step in front of a stock, you are going most likely going to get killed on it.
Do you still trade that way in some stocks, the market making kind of way?
Yeah, absolutely. So
Okay.
my typical day is usually like anywhere between 7:30 and 8. I'll know what low floats I'm going to watch on the day, and all the way up until 9:15, whichever names are still gapping up. So they'll go towards my low float watch list. But I usually have like a high volume watch list that I maintain on Sterling. So I have them sorted by volume. So every time I see Ford, GE, GM doing R-wall of more than two, I'm definitely in them. Every time I see NIO moving because there's some news in Tesla, or NIO has its own fundamental news of some sort of secondary offering, someone looking to buy a stake in them. So every time there's volume in a low priced large cap name, I'm definitely active on it. But given like the time of the day is when I feel most comfortable, between 11:30 and all the way up to 4 is when I'll be most comfortable sizing up into those names. Even if I'm watching a name like that at 9:30, my size is probably a quarter of what my size would be at 11:30, because seeing how the volume is on the day on any given stock, it's like a smile curve. Like first half hour, a lot of volume, last half hour, a lot of volume, and throughout the day, the volume just dies out until it picks up again in the last half hour or so. So, and if you look at ATR on the other range, average true range is significantly higher in the first half hour. So any market making stock has very few, only a few thousand shares on both sides, on the bid and the ask, in the first half hour, versus as the day progresses, the level to get significantly thicker. So something like NIO will have 3,000 shares on the bid in the morning at any given price, like 255, versus 255 at 2 p.m. would have like 45,000 shares. So that's my edge, that's my comfort zone, leaning on a bid or an offer, or wanting to flip down. I can see liquidity that I can smack on the way up or way down. So that's how I look at these market making names. I absolutely every day I have at least a couple of names that I trade actively, but it starts at 11:30, 12, and that's when I get really more active and also sizing up in those names.
That's interesting. Is that both long and short, or mainly long bias?
No, in a market making strategy, in fact, you can have no bias at all.
Okay,
So it is completely
explain
tape driven.
market making, because obviously I don't know what that means, because I thought it was something else. Go ahead and explain that.
So it's usually when what you're doing is seeing the book pressure, you're trying to position yourself. Now, if there's a stock which is going to be only in a 1 cent range all day, right? The stock is trading at $5. Let's say 5 bid and 501 offer. If the stock is going to be in that 1 cent range all day, the best way you can make money is buy as much as you can at the bid by adding liquidity in some sort and trying to get out a sell 501. Now, typically a stock doesn't do that. So stock can have a range of 495 to 505. So what you're doing is you're trying to time it in a way that if the stock is at 496 and the market looks like it's bottoming out, you would usually like to buy the offer, flip it up in a way that, all right, market's toughing up and now the stock is hitting $5 is a big offer. So you try to get out in front of it. So I'd sell 499 on a limit exchange order and probably get a rebate for that, get flat, and just vice versa. So rinse and repeat kind of a format. So that is market making in a nutshell for me. It's more like simultaneously trying to load up more shares on the bid, trying to sell some shares on the offer. But if I think that if the offer is going to lift up and go 1 cent higher, or if I can sell 1 cent higher, why would I be selling at the offer? So what I'll do is, in fact, buy back all those shares at 496 and sell at 497. But if I think 497 is going to go up, why sell everything, buy more and sell at 498? So that's more like a simultaneous buying and selling going on while having a feel for the book pressure.
Is that your favorite type of trading? It's like it seems like it's very flexible. Like you're going in, like just constantly changing.
So in this, first of all, you can't have a bias. You have to rely completely on the book pressure. You have to go with the tape. You can't be you can't be rigid. You can't. This is not like stepping in front of a on the front side of a low float stock. This is like if you are wrong, you're just going to be wrong. And if the stock only has 3 flips in any given day, you cannot afford to be wrong on it, because imagine if you sell the offer and if it goes up, now you're out of money by 1 cent. The stock is only going to have 2 more flips on the entire day. So you cannot afford to be wrong. So you have to always position yourself in the direction of the stock. So if the stock has a book pressure which is significantly favored up, you try to stay long. If it's significantly favored down, you try to stay short. So having that deep ingrained in your brain, or having that as the first strategy that I was profitable and most consistent with at 7 points, I feel I still carry those roots, or I still carry that strategy pretty close to myself. And I can also use that. I can apply that to trading a low float. Whenever it's squeezing through the day, high of the day, I'm not usually looking to step in front of it, because I know that if it's going up, if I don't want to get long, that's fine. At least don't step in front of it, don't short it, don't get stuck, and vice versa.
That's interesting, man. I wish we had a little bit more time, because I have so many more questions, and we might need to bring you back, because we just now started really getting into that, and I really appreciate it. So for everyone who's listening, we may, if you're okay, Krishna, if we can go a little bit longer, if you're okay with that, maybe like five more minutes, I appreciate that. Because I still had a couple more questions, and that is, if you could lay out, because I'm sure there's people out there who are listening to this strategy and they're like, I like that type of strategy, I would like to try that.
Right.
If you could just kind of, as simplistically as you can, how would someone go about, like, what should they be looking for? Because my thought is, don't use this in penny stocks personally, because if you're wrong, it doesn't only break that level, it skips, So to me, this is more for like bigger names, but if you can make it more simplistic for a beginner, real quick, easy steps, how would they put this into work and practice on?
Do you mean specifically the market making strategy?
Yes, that's right.
And applying that to low floats?
No, just for a beginner, I would say maybe not low floats, because it's probably harder. Like whichever is the easiest market, like how would you suggest someone go about it?
So first of all, like I think if you're trading on like an E-Trade or a Charles Schwab, it's probably close to impossible for you to press the buy button and then click yes, I want to buy this, confirm so many shares. If you're going to do that, it is not the strategy to go for. So we have like a lot of hotkeys. All the keys on the keyboard are completely marked for buying, selling, and you're just so quick in a flash that you can just buy and sell. If it's flipping up, you are so quick to react to it. So first of all, it would have to be you need to have access to a good market maker route. You need to have access to good midpoint routes. And then I think even before diving into this, I think market making is a strategy that you have to really have, you need to be focused on, you need to be able to watch the level 2 so closely. It isn't like you can't be trading off of the chart, because you just absolutely focused on the time and sales and the level 2. So corresponding action, the price action that goes on, you're really trading off of that. You could take off the chart completely if you wanted. I could do that for most of the stocks that I'm trading. You could only trade off the level 2 and time and sales, and you'd be comfortable with that, because that comes with 4 or 5 years of like just practicing market making, just doing that in and out, 3, 4, 5 stocks every day from 9:30 to 4. So it definitely takes thousands of hours of practice into it. But besides that, even if you had thousands of hours of practice looking at level 2 and time and sales and order flow, you would still need access to dark pools, market maker routes, midpoint routes, which is where the structure that we have, the setup that we have at 7 points, I don't think I could really pull that off anywhere else, like even any other prop trading firm out there. So given the structure, the setup we have, 7 points as a firm is what gives me the edge to sort of just be in market making stocks. So I would say having access to those resources. Now I know that there are quite a few other brokers out there. I'm not sure which one specifically, but I know that a few of them have give you access to like a midpoint route. They give you access to uh, like market maker routes, but the cost has to be significantly lower, because if all you're going to make on the best case scenario is 1 cent, and if your cost is 25 0.25 cents to buy, 0.25 to sell, you're not really making anything. Even if you're right, you give back half of that in fees. And since this is something which will generate a lot of fees, the cost structure is something that comes into effect along with all the other aspects that we discussed. So I feel like being a part of 7 Points is what gives me an edge, and which is why I feel like I've been very fortunate in that aspect. Having access to these resources, these routes, these exchanges, and on top of that, the cost structure that we have, and on top of that, my cats really showing us how it's done, or like teaching us some of these basic strategies that we obviously you keep trying in and out, and then you try to apply it to more momentum kind of names. So taking it from Zynga, AMD to I think someone out there could probably try applying it to Ford or a GE or a GM,
Okay.
which is thick again. So the best way to go about would be like someone, if someone only wants to watch the tape, maybe they could look at something like a Bank of America. You could look at XLF, which is a really thick ETF in terms of volume, in terms of level two as well. So you could probably look at something like that, and maybe also figure out, get comfortable watching such names, knowing what the ATR is going to be on the stock. Like something like a Bank of America only moves when the SPY is going to drop 0.5% or 1%. Otherwise, it is going to be choppy in a very tight range. So finding those setups is going to be essential, but you can always filter that by volume. You can find something that does at least 10 million shares on an average. And my other criteria that I add in is R wall of 2. So even if Ford does 15 million shares, I don't want to look at Ford every day. I only want to look at it when the R wall is significantly higher, or NIO for that matter. I'm only looking at NIO when the R wall is going to be above 3, 4, and it already has some amount of volume pre-market and has a catalyst to go with it. So I think when you combine these 3, 4, 5 things, that could be a good recipe to start off with market making.
Thanks, man. I really appreciate you saying that.
Yeah.
I appreciate you sharing that insight. And I think it's something that it's very different. A lot of people, I've seen people trade that way, and it's just like, to me, it's just foreign. So I appreciate you kind of laying it out for us there. I do want to
Yeah.
end it with one question, and then we could wrap it up.
Yeah.
And that is, if you could go back in time, back to right when you first joined 7 Points,
Right.
and you can give yourself one piece of advice to help expedite your success and get
Right.
that consistency and profitability, what would you tell yourself and why?
Um, I would say you've got to try a lot of things. I think partly I've over these past 6 years, I've probably had 10 to 15 different strategies that have absolutely failed, that don't work at all. But I wouldn't know that if I didn't really keep trying out new things. So I feel like I was fortunate to be surrounded by good, profitable traders, being guided by Mike Katz, Mike Mangieri. They've always been there as a backbone, but you have to keep trying different things. You have to fail at it to know that, okay, this absolutely doesn't work. I know that a lot of traders out there are usually very scared to try out new things. They only want to be part of, let's say, one chat room, and then they'll stick to it. But I would say that if you think that chat room is the route for you to go, might as well try out another one. Until you know what really works best for you, you got to keep exploring. And then if a strategy doesn't work, take some positives out of it, apply it to the new strategy, start from there, and then try to scale it up from there. So I feel like had I tried that pretty early back in 2014, that would have helped me a lot more. And even believing yourself that it's okay to fail, because when I started off in May 2014, I had 3 months where I could make zero progress. So, and back then I didn't know, you'd say you got to review your trades, but I didn't know how do you review your trades. Or even if I review my trades, I know losing trade, what do I take out of that? So it is really important for you to know what you're trading, why are you trading, And then once something works for you, you gotta use that as a base and grow from there. So I felt like those 3 months when I made zero money, which was May, June, July of 2014, those things taught me a lot because I was okay to fail. I'd sit down with my cats at 6 p.m. and Mike would be like, "You look so stressed. What's going on?" I'm like, "Mike, I'm down 3 grand in the past 3 months. I haven't made money." And he laughed and he said, "Do you think 7 points is going to close down because you're down 3K on your account?" And so it was always helpful to be with people who would back you up, who would guide you in the right direction, and he would tell you, if airlines are not working for you, stop being in airline stocks, stop trading them 5 days a week. If Facebook, Twitter, which had recently IPO'd in 2013-14, so I would trade them 5 days a week. So he would tell me to be more selective in a way that finding the edge, something that gives you a good risk reward setup, being in selective setups instead of being in Facebook and Twitter every single day. So those are things that I kept trying until I found the stocks that I was very comfortable with, which was oil names back in 2014. I still remember Thanksgiving 2014, which was the day before Thanksgiving was half a day, and oil was just getting to like get hit. Oil was in the $50 range, and before we bottomed out in the 30 over the next few months, that was the beginning of when I felt that was my aha moment. And I felt like, all right, this is what seems to have clicked for me, because I gradually went from trading Facebook, which was $70 back then, to Twitter, which was in the 50s. I gradually dropped down my price range and being in like $5, $7, $8 price range. But that only happened by trying, by failing, trying and testing new things. So I would say if there was one thing that I could tell myself, I should have kept doing that consistently. And that's something that I keep trying that. I keep trying a new strategy without hesitation, because I know that there'll be something positive out of it. And if it works, if it makes you money, then absolutely all the more reason to be in it.
Awesome, awesome. Well, look, Krishna, I really appreciate you being here today, man. If anyone wants to reach out to you, where's the best way for them to do it? Could you go ahead and share that right now?
Absolutely. You can always feel free to reach out to me on Twitter. My Twitter handle is Chris23Joshi, which is KRIS23JOSHI. And you can always feel free to reach out to me there. And I'm always happy to chat with people. Thanks again, Alex. I really appreciate you taking time, bringing me on the show. It's been a pleasure.
Hey, it's had a pleasure having you on the show, my man. So I appreciate it, and you have a good day, okay?
Thanks so much. Cheers, guys.